Do you know what's arguably more important than making good financial decisions? Avoiding bad financial decisions. A good financial decision can take you 2 steps forward, but a bad financial decision or a money trap can take you 3 steps backwards. And that's why in this video, I want to go over the 7 biggest money traps you want to avoid so you can build your wealth with less setbacks. Money trap number 1 is lifestyle inflation. Right now, we have a lot of people that are making $50,000 a year that are living a $55,000 a year lifestyle. That means you make this money from your job, your business, does not matter. Then you spend money on your car payment because you want a nice car. Then you got your housing costs, maybe it's your rent, maybe it's mortgage because you want a nice place to live. Then you got to pay for your credit card bills because a lot of people carry a little bit of credit card balance. And then you got your other expenses, your fun, your entertainment, your clothes, and just travel. When you add all that up, what you'll see is that a lot of people are living this $55,000 a year lifestyle, making $50,000 a year. And then everybody says, man, if I could just make an extra $10,000 a year, all my financial problems will be solved. And then maybe you go and earn it. You go and get a raise, you go to get a job change, and now you go from making $50,000 a year to $60,000 a year. But then suddenly what happens is your expenses grow from this $55,000 a year, which by the way is because you have debt. That's how you can spend more than what you earn, and most Americans are in debt. But now you go out and you make an extra $10,000 a year and you think that now you're going to have more money to save, more money to invest, and some extra financial cushion. But then all of a sudden, your expenses grow from $55,000 a year to $65,000 a year. Why? Because now that you're making an extra $10,000 a year, maybe you don't change where you live. Maybe you don't change your car just yet. But maybe you go out and buy a few more things. Maybe you go out and start buying the organic foods. Maybe you go on another vacation. Maybe you go and spend money in a couple other places, and now all of a sudden, that $10,000 that you're making more of is now gone. But then maybe you go back to school, you get a new certificate, you get a whole new career, and then maybe you work to increase your income even more. Now you go from $60,000 a year to $90,000 a year, and now you think that your financial problems are all going to be solved because, well, now you're making a whole lot more money. You were spending $65,000 a year. Now that you have more money, you should be able to have a lot more freedom, save more money, invest more money, build real wealth. But then what ends up happening to a lot of people in this situation is you start making $90,000 a year, and now that you make more money, banks look at you and they say, you are a more qualified borrower. How about we give you a better mortgage? How about we give you more money for a car? We might even be able to give you a better interest rate if you have a little bit of extra money to put down. So now what ends up happening to a lot of people in this situation is this is now when you go and you get a better car. You go from driving maybe a Toyota to a Benz. Maybe you go out and get yourself a nicer house. You go out and buy a house a little bit bigger. Maybe you rent a nicer townhouse. You put a little bit of extra money in your credit card, and now you go from making $90,000 a year to spending $100,000 a year. This is why most young people that are making 6 figures a year are broke with no savings, no investments. This is called lifestyle inflation, and it holds so many people back from ever building wealth because as soon as you start making more money, you start spending more money, and you never have the ability to ever build wealth because you assume that as you make more money, you'd be able to save and invest more money. But if you can't find a way to do it today, there's no guarantee you'll find a way to do it as you make more money. Money trap number 2 is you're waiting for the X factor to start investing. This X factor is whatever reason or excuse you're telling yourself as to why you don't want to start investing right now. Maybe this means you want to start making more money before you start investing. You want to see a pay raise before you start investing. You want to have some other financial things done before you start investing. Maybe it means you're waiting for a better price to start investing. You're waiting for the stock market to crash. You're waiting for a housing market crash. You're waiting for a time where you can come in and buy even more. Now, market crashes create amazing buying opportunities, but if you're always waiting, you're going to be sitting on the sidelines and missing a whole lot of gains. And this is where it can be valuable to take advantage of a market crash with extra money that you have, but just waiting for a market crash means that you might be missing out on a whole lot of gains. Number 3, waiting for a change in the economy, waiting for better interest rates, waiting for the government to change something before you start investing. Well, you could be waiting on the sidelines for a long time because nobody knows what's going to happen. Or you could be waiting for more experience. I don't know how to invest. I don't know how to start. Well, sitting on the sidelines is not going to help you, but you can get started. Start with $10, $100, $1,000, whatever's easy enough for you to start with. The key is to get started. The reason why so many people don't actually make the wealth that they want isn't because they picked the wrong investment or because they picked the wrong stock. It's because they never start. You are going to make mistakes. Investing has risks. In fact, you will lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But unless you start, you're never going to actually learn. And the reality is, if you want to be able to take advantage of the big run-ups, you have to invest your money. Franklin Templeton did a study on this, and what they found is that if you invested your money into the stock market in the year 2000 and you kept your money there for 20 years, so until the end of 2019, your money would have more than tripled. But if you were trying to time the market and you missed the 10 best days over the course of those 20 years, just 10 days you missed, you would have cut your returns in half. Just because you were trying to time the market. That's why it's so difficult to try to time the market. Now, if you see a market crash, that could create a great buying opportunity, but if you're always waiting for a market crash, you can also miss out on all those gains. Now, if you are an investor and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we cover what's happening in things like the economy, stock market, housing market, crypto market, and global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to join hundreds of thousands of investors that are reading market briefs every morning, I got the link for you to join down in the description below. Money trap number 3 is you're financing a new car when you should be buying one with cash. Financing a car gives you a triple whammy. Number 1, you are buying a depreciating liability. That means you're buying something that loses value. When you go out and you buy the BMW, you buy that whatever car you want, it starts to drop in value as soon as you put your keys in the ignition. But then number 2, you're paying interest to buy this thing that's also losing value. So now you buy this thing that you know is going to drop in value, but you also have to pay the bank interest every single month. And then number 3, it has a limited life. It's not like after 5 years, this car is going to be able to have better performance. That car loses its value and it has a lower and lower lifespan every single time you drive it. At the time of me recording this video, the average new car payment in America is $737 a month, and the average used car payment in America is now $520 a month. Again, you're paying interest on something that's losing value. Now, here's the thing. When you go out and do this, you're also going to put down a down payment on the car. If you're putting 20% down, this used car payment means you probably put down around $7,000 to buy this $35,000 car that's going to cost you $520 a month. What I would like for you to do, especially if you haven't built your wealth yet, is instead of making your banker richer, instead of making the car company richer, use this money to make yourself richer. Take the $7,000 down payment and use that money to buy a car. Now sure, maybe you don't get as nice of a car, but you can get yourself a nice 2012 Toyota Camry with the $7,000 down payment. Look, I'm talking to you from experience here. I just a few months ago in the end of 2024 got rid of my 2007, 2008 Toyota Solara. I had a lot of miles on the car. I had 3 different types of rims on the car. I had rust on the car. I drove that car into the ground, but I got my money's worth out of that car. Yeah, it's not as nice as what you can get over here, but guess what? You get to save this money or invest this money every single month, and this is what can make you wealthy. I'll show you what I mean. If now I learn about this early, I learned about this in my 20s, and I don't go out and finance this car, I buy a car with cash for $7,000, and then I take this $520 a month and I invest it into the markets every single month. And I don't do anything crazy with it. I just get the average historical stock market return, which is average around 10% a year. And I do this for 40 years because, again, I started young. If I do that, I just take this car payment and invest into the markets and I get this 10% return, this $520 a month is not going to grow to $500,000. It's not going to grow to $1 million. It's not going to grow to $2 million. It's going to grow to more than $3 million. But instead, what you want to do is you want to go out and you want to finance a BMW today. You want to go out and finance a Hyundai Genesis today. You want to do that today so you can look like you're rich, when in reality, if you really want to build wealth, you're going to drive that beater car for a little while. That way you can take this money and keep investing it and then buy a car that you can afford with cash. Money trap number 4 is you don't act your wage. Look, I don't make these videos to get you to like me. I make these videos to help you be better with money. And the reality is you got to understand where in your financial journey that you are, because you can go to any YouTube or Google or whatever and you'll see financial influencers talking about how you should have Starbucks, you shouldn't buy Starbucks, how Starbucks is making you rich, how Starbucks is making you poor, or how you should cook at home, or you should only go out and eat. It doesn't really matter, but the reality is you got to know where you are. That's when these decisions make the biggest impact. The reality is, if you don't have any savings, you don't have any investments, and you're drowning in credit card debt, then yeah, you should not feel comfortable eating at Starbucks. You should not feel comfortable eating at restaurants. You should not feel comfortable watching Netflix. This is my thing. I say that if you are in what I call the financial danger zone, meaning either A, you have credit card debt, and or B, you don't have at least $2,000 put aside to protect you against an emergency, $2,000 to start your emergency fund, you are in what I call the financial danger zone. And if you are in the financial danger zone, you can't afford Netflix. Not because it costs $15 a month, because it's costing you 2 hours of time a day. The average American is watching more than 2 hours of TV a day, and I have no idea how you could feel comfortable sitting there on the sofa, sitting on your butt watching TV when you got credit card debt. You got bills to pay. You don't have any cash in the bank. You can't feel comfortable doing that. How are you going to take care of your family? How are you going to provide if anything bad were to happen? You got to get serious. Turn this TV time, this brain rot time into earning time. Go out and earn some money, go out and work, or go out and learn how to make some more money. Spend that time learning how to make some more money. Spend that time learning how to manage your money. Spend that time learning how to invest your money. You should not be comfortable watching Netflix if you got credit card debt or if you don't have $2,000 saved up. But when it comes to these things, talking about whether you should buy Starbucks or not, it really doesn't matter. If you can afford it, it does not matter. I don't care if you eat out every single day if you can afford to do so. I don't care if you eat Starbucks or drink Starbucks every single morning if you can afford to do so. If it adds value to your life, go ahead, do it if you can afford it. If you can't afford it, you should not be spending money here. Money trap number 5 is you never have any cash. Now, when I say cash, I don't necessarily mean keeping cash in your pocket, although a little bit of cash can always help you. What I'm talking about here is having some savings. Now, you've probably heard me say that your savings are losing value to inflation. I've been saying this since 2016. But the reality is you do want to also save some cash. You just want to save that cash strategically. That means having a reason to save your cash. The reason why I say this is because growing up in a traditional Indian house, you were taught to save, save, save. Why? Because saving is supposedly how you're supposed to build wealth. When in reality, your savings are not going to make you rich, your savings are not going to make you financially free, and your savings are going to lose value to inflation. But that doesn't mean you shouldn't have any savings. In fact, you're losing out on big opportunities if you don't have any savings. And there are 3 reasons why you want to save money and you want to have separate piles of cash, separate savings accounts to help you do this. What does that mean? Number 1, having savings for an emergency. You want to have somewhere between 3 months to 12 months worth of expenses put aside in an emergency savings fund. The amount of money you save is going to depend on where you are in your life. If you're 25 years old, you're not married, you don't got kids, you don't got a lot of financial responsibilities, you probably don't need a year's worth of savings. Maybe just a few months. That way, if you lose your job, you don't got to worry about how you're going to eat or pay your rent. If you're 45 years old, you got kids, you got a spouse, you got a husband, you got a wife, you got parents you got to take care of, you might have more financial responsibilities and not feel as comfortable taking on more risk. Maybe you need 6, 9, or 12 months to make you feel comfortable. Whatever that number is, once you hit that savings goal, you don't need to keep saving more and more emergency money. Then you got to start putting that money to work. But somewhere between 3 to 12 months worth of expenses put aside, because if bad things were to happen, you can continue living your life. Number 2, you want to save money for an investment. I talked about this a little bit earlier in this video. The reality is market crashes happen and recessions happen. Over the last 100 years, the United States has seen 16 recessions and we've seen about 25 bear markets, meaning about 25 market downturns, about 25 market crashes in the last century. That means you can expect that we're going to see more recessions, more market crashes in the future. Who do these hurt? These hurt people that panic, and they hurt the people that don't have the opportunity to come in and buy. Imagine if you were buying stocks during the 2020 pandemic when the stock market was crashing at record speeds. Imagine if you were buying real estate during the 2008 housing market crash when real estate prices were crashing. Imagine if you were buying stocks in the 2000 dot-com bubble when the markets were going down. They create amazing buying opportunities for those that, number 1, financially savvy, and then number 2, that have cash. This is where you want to have some cash put aside, some money put aside to be able to capitalize on those opportunities when they come your way. Most people will be panicking. You want to be the one that's coming in, buying those good investments at a discounted price, but you need some cash to be able to do that. And number 3, you want to have cash to make a big purchase. You want to buy a nice new car. You want to buy a Rolex. You want to buy yourself a nice whatever house. You need money to do that, and you don't want to have to rely on going into debt or selling your stocks to go out and make that purchase. Money trap number 6 is you are paying the loyalty tax. If you sign up for any sort of utility subscription, chances are that company is going to be raising your bill year after year after year, even if they don't tell you, because, well, a lot of times they just throw that into the terms and conditions. So if you have a phone bill, AT&T, Verizon, if you have insurance, Progressive, State Farm, Geico, it does not matter. Chances are you've probably seen your bill rise year after year after year after year, and they know that a lot of people are just going to pay it because they don't want to have to deal with the headache of shopping around. Well, here's the reality. You should shop around, because if you're constantly just paying the higher price, you might be overpaying. And what you can do, instead of having to fully change the plan, is just look at what the competitors are charging. And if you see that their competitors are charging a lower price, now you can take that as ammunition, be nice, call the customer service agent, be nice, because they're getting yelled at every single day. Yes, I said be nice multiple times. The reason why is because if you're nice to them, they'll be nice to your wallet. And you can ask them, hey, I've been a subscriber for X number of years. I've noticed that my bill has gone up so much. Is there anything that you can do? See what they can do. See if they can lower the bill. Once they lower the bill, say, oh, thank you for working with me, but it's still pretty high. I noticed that your competitor is charging me this price. Can you beat that? They'll probably come back and try to beat that, because it is cheaper for them to keep you as a customer and give you a discount than it is to lose you as a customer. And then once they come and lower the bill, that's when you can come in and say, wow, I really appreciate you working with me, but could you do a little bit better? And that's when you can come in and try to offer a lower price. This is how you can get your bills lower and not have to sacrifice any of your stuff. And it works in any aspect of what you're spending money on. If you have a business, you will see a lot of expenses like this. If you invest in real estate, you will see a lot of expenses like this. I own apartment complexes. In these apartment complexes, we have dumpsters. Well, those dumpsters, you got to pay a fee to get those dumpsters, and I don't know what it is, but those dumpster companies will jack up your payments, the amount of money you have to pay every single 6 months. And it's not those small little 2 or 3% increases. They can be massive jump ups. And all I have to do is either me or have my property manager call them. It's almost like a scheduled thing in our calendar that we have to call them regularly and just say, hey, you jacked up our bill too much, bring our price down. And then every time they just bring the price back lower. Yes, sometimes it doesn't work, but sometimes it does, and it can help you lower your payments without having to sacrifice anything that you have. And money trap number 7 is you are fake rich. This means you are paying or overpaying for status when you can't afford it. Look, if you don't like what I've said up until now, you're definitely not gonna like me after this, but the reality is, if you own a Rolex, if you own a BMW, if you own some Gucci, but you don't own at least that much money in your investment portfolio, your stock or real estate portfolio, you are fake rich. All of these things, your watches, your clothes, your vacations, your cars, these are all luxuries. And when it comes to luxuries, those have to come after your assets. Those have to come after your wealth. And so now you gotta play the game a little bit differently. A simple rule of thumb that I follow, especially when it comes to luxuries, is my rule of 5, which says if I can't buy 5 of them, I can't afford one of them. If I wanna go out and buy a $10,000 Rolex, well, I better have $50,000. And you can start to see that's a little bit extreme. But the Rolex is not adding any value, any financial value into my life. I want to make sure I build my wealth, take care of my family, take care of my foundation before I go out and start spending money on these luxuries that just make me look rich. I want to have my wealth first. Yeah, it's difficult. Yeah, it means you got to make more sacrifices, which means if you want to go out and buy a $100,000 car, you better have $500,000, but it's difficult. But the problem I don't want to have is now spending so much money on this nice car that now I'm struggling to pay for the premium gas, which is apparently a big problem, especially if you go to Miami, especially if you go to a lot of these places where a lot of people just want to stunt. They want to look like they're rich. Well, you're fake rich. And if you're struggling to pay for the premium gas, if insurance is a big concern for you, you shouldn't be buying the car in the first place. Look, the ultimate key to building wealth is to keep as much of your money for yourself. You're working hard to make the money. You're working hard at your job. You're working hard at your business. You're working hard to do whatever you got to do to make your money. But then when you just go and give it away to other people, you are making them rich. Nothing wrong with spending money. There's nothing wrong with having nice things. There's nothing wrong with wanting nice things. I want you to have all the nice things. I want you to have all the expensive luxury things. I'm not against that. But I am against it before you have your wealth. I want you to make yourself rich before you make everybody else rich, because if you can make yourself rich, now you can buy all those things and not have to worry about the money. That's what I want for you. The problem that so many people are making is they want the nice things today, so you're working hard, and instead of making yourself rich, you bypass that step. You just go work hard and then make everybody else rich, so now you look rich, when in reality you're just making everybody else rich. That's the mistake that I want you to avoid. And that starts their mindset changing the way that you think, working for the long-term wealth, because the long-term wealth is sustainable wealth. Now you can work to make yourself rich for the rest of your life and never have to worry about money again. You can set a foundation for your kids, for your grandkids, and give back to your community. Because the more you have, the more you can do. But that starts with you understanding how to use your money the right way. If you really want to build wealth and never want to stress about money again, there are 5 different types of assets that you want to buy. The problem is, if you ask the majority of people, they'll tell you to buy a random stock or cryptocurrency and hope that you get rich. And that's why most people end up losing money when they invest. But that ends today, because in this video,